So welcome. I gotta make sure to turn off my YouTube volume because I don't want to get the feedback.
Oh, that is a good point. Let me go on ahead and turn this down.
It's always funny, like who's gonna be the first one into the chat, like who's here?
Who is it? Who's here?
About to find out. I always like to call it out. Here we go.
So y'all see people pop up on YouTube?
Yeah, so we can see people in the chat.
Okay.
And it was, oh man, it was Christian. You were the first one here.
What's up, Christian?
Up. Talk about, oh wow, somebody came in coming in hot, like talk about fundamentals.
Damn.
Good evening, everybody. I hope that you guys had a wonderful day. This market was quite poetic. I mean, there was a lot of things that happened. You know, apparently we've had some new people knighted. We saw some new kings and queens of the market today. So I guess we're going to talk about that. Right, Jolene?
Yes. Indeed.
And then we got an awesome guest with us today. So this is going to be dope. This is going to be a good episode. I can feel it. Oh, we got somebody from Japan. So you're already here. You're already like ready for it. So go ahead, like we do in normal come up fashion. Go ahead and shout out where you're coming from. We definitely want to know. We got Seattle in the building, of course. Matt, Seattle investor. Oh, that's an interesting name. We got South Florida. I spent hours doing fundamentals. Okay, well, you know, that's not a place, but you know, that's definitely, you know, somewhere on a sheet. Congratulations. Thank you everyone for shouting out the Dark Knight gang. We got people in from Fort Worth, Texas. Nice, nice, nice. Savage move by Tesla. Vegas in the building, San Antonio. So what we like to do before we even start the video, we definitely like for you, if you haven't subscribed yet, which, Jolene, why haven't they subscribed yet?
You know, I'm trying to figure that out. We all out here coming up. I mean, come on now, come with us.
I mean, we got people from Buckeye, Arizona. We got people from South Carolina. We got people from Japan, Africa. I mean, yo, join the movement. Like, be a part. Like, and it's free. You know, what do you lose? I mean, maybe an hour of your time, but you know, we'll try to make it valuable. But if you can, be gracious and hit the subscribe button. And if you do like the content and what we provide, go ahead and smash that like button. And if you don't, go ahead and hit the dislike button, but please tell us why. And if you want to know when we're dropping content, you know, there could be something in the pond, you know, dropping tomorrow. You never know. But, you know, you never know when it comes out. So hit the notification bell so that way you can be a part of the squad. All right, Jolene, it is officially 5 o'clock Pacific time.
Are we starting early? We normally start at 5:04.
I know, but I'm just saying, like, yo, there's so much today. Like, I'm just reflecting, like, you know, we have folks doing doing splits. I'm thinking I'm seeing double takes. You know, we got we got rotation happening.
Yes. Oh my gosh, the rotation was real, y'all.
I mean, you would think that a lot of these companies that got rotated into that they had stellar earnings or that they had a stellar year. You know, Brother Man's a little confused, so maybe you'll be able to help me out there. And then, like I said, we have this wonderful guest with us that we get to sit down and talk shop and talk money with, which, you know, we'd love to do that all the time. Definitely hit us in the questions and the comments because we know that you guys stay lit. I'm definitely gonna should we do gems today or should we do keys? How about we ask the people that? Shout outs to Earn Your Leisure and Christopher Bush for hitting us up. Oh, by the way, Jolene, maybe you should tell them where the actual super chat money is going to this week. We really want to know.
I would love to. Just in one moment here.
Oh, okay.
For that. Hold up. It's actually pretty cool, y'all. Hold on.
Ooh, somebody from Toronto.
Here we go. All right. So
we got the Earn Your Leisure squad in the building.
This week's super chat dollars go to Live to See Cancer Cured. This nonprofit organization was submitted by Preston Robinson Jr., who is on the board of this nonprofit. The story is pretty incredible. Let me just read to you a little bit about this organization. It's been, hold on, let me go to their story.
Now, where are they located, by the way?
New Orleans, actually.
Hey,
Mm-hmm.
That is what's good.
So we branching out or whatnot. Okay, so Live to See Cancer Cured was co-founded in 2012 by Cameron Washington, a native of New Orleans and childhood cancer survivor. Since his diagnosis, he has been an ambassador for pediatric cancer awareness and helping newly diagnosed kids adapt to the new normal in their life. After his diagnosis of an inoperable tectal glioma, 8-year-old Cameron, he was 8 years old, with the help of his family, had to recreate his life of simply being a kid. And so now you can feel free to go to live to see the letter C cancercured.org to hear more of his story about why he started this foundation. But essentially it's to help children establish a new normal in their survival when it comes to cancer. So it's like, think of young champions fighting off cancer. And that's the heart of it. And they want to provide support to not only the children, but also the families that are involved. And it'd be really cool to meet Cameron, actually. He was the recipient of the prestigious Joseph McCloskey Schmidt 5-year high school scholarship. He's currently in college now.
What?
Yes. So him, along with his mom, they're the co-founders. They strongly believe that helping kids create a new perspective is the best way to help them become survivors that grow up paying it forward by helping other kids live their best life after cancer and establish their new normal.
Nice.
So they have a whole bunch of different programs and offerings. So I encourage you all to go on their link and check them out.
Yes. And so now you know where 100% of your super chats will be going to this week. So what we mean by this week, every week we pick a nonprofit organization or some kind of cause that we definitely want to get behind. And we literally say, okay, hey, if you put the capital in the super chat, it's there. So let's do it, y'all. And you know what? I definitely want to meet Cameron.
Yeah, Cameron, holler at us. Press, yes. You holler at us too, because you're the one who nominated Live to See Cancer Cured Foundation. So, yeah.
Dope. All right. So, by the way, shout outs to many of you who are dropping capital into the super chats. You guys are super duper awesome. Troy, we see you from Earn Your Leisure. They had a great episode yesterday from Market Mondays. Shameless plug to the Earn Your Leisure squad. But without further ado, it is officially 5:05, Jolene. Check that out. So who is this person that is in this awesome blazer, by the way, with the Murray State behind them? Oh, we got to know who this
we're
person
is. We're gonna get into that. Wait, first of all, I'm sorry, I misspoke. It was his mom. I said it was his mom. It's actually his aunt.
Oh.
That started the foundation with. So just
hey, auntie.
Right. Right. Retract that. Okay. So I'm gonna leave you all in a little bit of suspense before we introduce our guest, because we definitely need to cover the overview of the market of what happened.
Oh, well, let's do it. Let's
real quick. So stay on the edge of your seats. All right. So first of all, what's up, y'all? Welcome to what is this? Straight Talk Tuesday? I'm already thinking of Thursday, y'all. I don't know why. I'm just like, oh, you know why? I know why. It's because of the news that was going on that we'll get to later. That's why. But this is Straight Talk Tuesday. And let's see. It was all red everywhere. The Dow negative 104.53 points. S&P 500 negative 26.78 points. And the NASDAQ a negative 185.53 points. It was red across the board. But you know what? I think it's going to be good tomorrow. We'll see. For sector performance, something rare that barely happens. We got financials leading the way, followed by industrials and materials. And then our bottom feeders would be tech, real estate, and utilities. Then when it comes to our stock picks, we got Qualcomm, DraftKings, and Boeing in the top three. And then our bottom three would be Hero, ARKG, and our little boo AMD. Now, despite how crazy the market was and the rotation, which we'll get into, we had three 52-week highs. We got Best Buy, XLY. You already know, we posted that yesterday. Y'all should have been in the stories. You would have saw that. Okay. Right. And RTH. So those were the 52-week highs. So you can kind of see some themes there. We can talk about that. But without further ado, let's get into who this guest is. Y'all kept you in suspense for hello. Y'all, you know me. I'm so excited to have our guest today. I'm really, really excited. We've been chatting for a couple of weeks now, and I just thought it would just be awesome to have Coach Khadijah Head on the show with us today. Three words that describe Khadijah, besides head coach. Well, head coach would be one of them, but she's also a mentor and an educator. She was born and raised in Atlanta, Georgia. And she makes a living as an NCAA Division I women's basketball coach at Kennesaw State University.
Hey.
Her business card reads associate head coach, but she prefers to tell people she mentors the 18 to 22-year-olds, which is such a pivotal role. Thank you for that. An avid reader, Smart Women Finish Rich was her first investment book. Now that she's on the Come Up series, she's on track to help all those around her become wealthy. So without further ado, let's welcome Coach Khadijah Head. Woo.
Hey.
Welcome.
Round of applause. What's good?
It's so surreal because I'm watching y'all the same way I usually watch you on Tuesday, but I keep seeing myself and I'm expecting to see someone else in the box. So I just want to encourage everyone that comes after me, go for what you want. Like, I'm just a random person that saw two people that look like me and they made me feel like my dreams were possible. And I decided to be persistent, put myself out there, because the only way I am going to become better is I take action. So Mark, Jolene, thank you so much for having me today.
Thank you for
being here.
Us.
For real. Y'all, you heard her. So now ain't no excuses. We'll be sending out the link for potential guests. I mainly focus on getting some women on our show. So, you know, guys, you all can get in where you fit in. My focus is on the ladies first.
They can come talk to me.
Anyway. All right, so we need to talk about you as an investor. Let's talk about what your origin story is.
We call this like, let's talk about your lunchbox. So
yes.
Definitely.
Okay, I'm gonna give you guys my lunch. I'm gonna give you my lunch box and I'm gonna give you my lunch bag, and my option is my lunch bag. So my lunch box, my parents, they got me into investing early. So my first paycheck, my mother made me take a portion of that and invest in Home Depot. So Home Depot was the very first stock that I invested in, and I had no idea what was going on. I knew I'm from Atlanta. I see the big orange sign, Home Depot, and I felt cool because I was like, yeah, I own a piece of that. So as I matured, I really ventured into my own investment journey, and COVID really brought it to the forefront for me. So I am a member of the stock club. So I'm a huge Ian Dunlap fan, and I am an earner. And I really wanted to take responsibility for my financial future. So I invest in Ian's retirement picks. If you're not in the club, I can't disclose, baby. I ain't trying to get kicked out of the club. I'm not trying to get kicked out of the club. I'm on the Zoom
side. We understand.
Yeah, yeah. And then with options, I got into options on a whim off of Twitter. So I saw someone tweet an options play, and I watched the episode with Rubel from across the street, and you guys asked him was he in a long-term or a short-term option play? And he was like, a short-term. We asked him how long it was. He said 6 months. And I'm thinking, what am I going to say? Because mine was about 3 days. So mine was a mini blink of a blink. And it worked out. And so I thought I hit the jackpot. I was like, oh, this it. This it. I was a copycat. This young lady, she told me what to do. I did what she told me to do. And of course, I was successful. So I thought, I'm the guru now. So I cashed out. It was a June 21st play. It was with Apple, $400. The expiration date was July 17th. I paid $95 for it on June 23rd. So 2 days later, you know, I saw that percentage side on the right side and I was like, oh, what do I do? And she said, cash out. So I cashed out. And, you know, I had enough to, you know, put some gas in my car, get some Starbucks. So I felt like I was on top of the world. So of course, the first thing I did was take my profit and went into another play. I lost all that little money. So that's a little bit about my options journey. I started very, very short. And since discovering you guys, I have ventured into the long-term options community. So thank you for having me.
Welcome aboard.
Well, welcome. Okay, so, you know, I'm curious. I don't know about you, Mark, but I want to know how your on-court life impacts or influences your off-court life when it comes to training. Like, are there any lessons that you take from the court and apply it to your portfolio or your trading strategy?
Yes, lessons from the game. Let's hear it.
Yeah, so there's a direct correlation for me with recruiting student athletes and researching stock. So here we go. So it's just like, it's easy to
hold up. Rewind. That's a lot of jewelry there. Replay that again.
There's a direct correlation between recruiting a student athlete and researching a stock, a company, an ETF. The more you put into getting past the flashy aspects of it, the more comfortable you will be. So on the recruiting side, it's easy to walk into a gym and identify the best player on the court.
For sure.
You know, and it's the same thing with a great company. It's super easy to look at a list of companies and see which company is going to give you the biggest return on your investment. But when it comes to a student athlete, you could just be watching one good game with that student athlete. And then with a ETF or a stock, you could just catch them at a Kodak. You know?
Better preach.
And you see, you're like, oh my gosh. But then on the flip side, you know, as the recruiting matures, you get a chance to speak to the student athletes. I call it a personal board of directors. So the individuals that know that person the best, because you can't sacrifice a good player for a good person. You want to find a good person that just happens to be really good at basketball, because that's what you're building the foundation of your program on. And when you look at a company, you want to make sure you identify a company that has a great CEO. You look at their books. All right, what are they doing with their money? If they're not a profitable company, why aren't they profitable? Is it because they reinvesting into growing the company, into R&D, research and development? So it took me a while to get there. You know, for me, I saw the zeros and the commas and I was like, I want it.
Right.
And the more I learned about just basically watching you guys and the input that you give us, you don't just tell us, hey, here is the finished product. You give us a carrot. You allow us to grow in our own way, in our own speed. And I really appreciate that, because I feel like that has helped me so much in my investment journey. I have not jumped into my large option plays. I got some little minnows out there. I got, 2 options contracts on NIO, one on XLK and one on SMH, because I needed to see it work.
mean, I guess SMH is bay to a bunch of people now. So that's super duper dope. And the fact that you're able to kind of like apply everyday life into bringing that into strategies and how is it that you are able to dissect companies. I mean, that's purely fantastic. So I gotta ask you. So what do you think about this current market?
I think it's awesome.
Okay.
I am excited because it's all new to me. So I appreciate the highs just as much as I value the lows. Now, I'm not gonna lie and say I know exactly what's going on. All I know is when Apple split, Ian said yes, so I said yes. And he said Tesla split, he said yes, I said yes. So when I look at my investment strategy, it's imitation. You know, I'm standing on the shoulders of you giants because I understand I can see further, but I'm super excited with, you know, everything from 9:30 to 4, I'm into it.
Nice. All right. So what would you like to ask us?
Okay. So my first question, a couple of weeks ago, you guys gave us some homework to determine the strike price on XLC. And this was before last week when you gave us the formula to come up with the strike price. So I was looking at the year over year average and I came up with a dollar amount. I think I came up with 65 and I sent it to you guys, and Jolene mentioned to me that it moves, ETF moves much slower than other ETFs, and she guided me to the trader's cheat sheet. But once I got there, I didn't understand what I needed to look at. So if you guys could talk about how to determine the speed at which an ETF or a stock moves when we're determining our strike price.
Okay. So let's, for everybody out there, and that's a very good question. You know what we got to do?
Pull up
Go
the
ahead.
chart.
Just go ahead and just go ahead and say it.
Pull up the chart. Let me check in with the comments while you pull up the chart.
All right.
Hope y'all giving me some love, baby.
Oh yeah, they are. All right. So does everybody see my screen?
Yes.
All right. You know what we got to do, y'all. We're here now. All right. So here is XLC. Now, the reason why we say that, say, for example, XLC sometimes moves slow, though it has very awesome companies in there. Like, for example, it has your Facebooks, it has your Google, it has your Netflix, it has your Disneys, your Verizons, and many, many more companies that are in there. The problem is with the XLC position, and it's still a slow creeper. So if we look at, say, for example, the max chart for this, there really isn't a lot of time that's been pretty much used for such a position. So it's one of the fairly new ETFs to the Spider Select family, so to speak. So it's still trying to like pretty much grow its wings. But the cool thing about XLC is the fact that it kind of gives you something a little bit steady, of course, a la COVID-19, if we excuse that, but pretty much it gives you something steady in comparison to, if I compare it to anything else, I'll compare it to, let's say, the leaderboard, which is your XLKs of the world. And as you can see, they pretty much move in tandem, except that, again, it's just a little bit slower. Now, if I remove XLK off the board, you were asking like, well, why is it move slow? Well, look at the volume. It's not trading as much volume as, say, for example, its other counterparts in the Spider Select. So, for example, if I pulled off, let's just quickly look at XLK real quick, just to show the difference in volume. So whereas XLC was trading at 3 million shares, XLK today traded at 9.4. If we look at, you know, one of the other ones, which is consumer discretionary, you can see that it kind of trades at the same, but on par. But the only biggest differentiation is that it has Amazon sitting there at the top, which really pulls the XLY across the entire position. And so when we talk about a 1% movement in Amazon, and especially when it represents close to 30% of the entire XLY ETF, that's major. So I guess the best thing to say, and if we're looking at, say, for example, so walk us through, well, real quick, walk us through how you came to your strike. Let's go for it.
Uh-oh, quiz.
Oh yeah, we gotta make sure.
Okay, so I'm gonna show you guys. This is my homework from last week.
She did her homework.
I dubbed it the Dark Knight Strike method.
Love that. That's so cute.
Shay came out the gate, and my first benchmark is to identify if this ETF is at its 52-week high. Because eventually, if it's high, I'm not gonna jump in right away. I'm gonna let it calm down, and I'm gonna ride the wave with it up. So that's my first check mark. The next thing I do is determine the current price. So we're looking at 58.84. Okay. And then I go down to the 2-year performance, and I look at $9.57. Okay. Here comes the math. Spoiler alert, Chico. I had to come up with an Excel spreadsheet because my math is super iffy sometimes. It just abandoned me. Murray State, I got the degree, but I promise you, my math sometimes is iffy. Okay. So the next thing you want to do is you want to divide that 2-year number, so 9.57 by, I'm doing a 2-year contract, 2-year term. What's that? Is that correct terminology?
Yeah, 2-year contract.
2-year contract. So I want to divide that by 1.5.
Now, do you know why we're dividing that by 1.5?
Yes, because whatever, I'm not going to be in it for the full 2 years. So I want to be able to exit within a year and a half. Okay. So the next thing I want to do is I want to take, once I get that number out of the equation, somebody need to do that math for me.
That's $6.38.
Okay. And then you want to add that to the current price. Yeah.
So the current price is $50.84. So 58.84. So that brings us to 65.22.
Okay, and then you want to multiply that by 1. Okay.
Why?
Because so 0.1 is 10%, so that's correction. You want 10% correction. Okay.
All right.
Okay, and then so you want to take a big. I hope my mama watching. I hope my mama is watching. Okay, so the next thing you want to do is you want to take that your strike price we just came up with, and you want to subtract it, and I call it my shave amount. So that's the strike price times.
So we'll say 65 minus, we'll get rid of the 22 cents. So 65 minus $6.50.
All right. So the last thing I want to do, I want to come up with, I want to add the 2 strike price I came up with. So I have my primary strike price, then I have my secondary strike price, add those together. And then I want to divide them by 2 to get the average. And ladies and gentlemen, the Dark Knight strike price method.
That is fact.
I'm so proud of you. This is so dope.
She did.
It's not a Excel spreadsheet in a Google Doc, so I would love to share the link with anybody because I'm telling you.
All right now.
True story.
We got someone saying she dropping gems. Okay. Someone else said due diligence. We got a lot of welcome, coach. A lot of love.
Yo.
Someone said she showed enough drop gems.
That's the making of
new coach come through.
Yo, that's the making of a Justice League. I think somebody's been knighted to the Justice League there. So welcome, head coach.
Yes.
Yes. Wow. I'm stunned, like in the sense of like in awe. Like the fact that, hey, now let me ask you this, like, how does it feel now that you can take that method and you can apply it to, say, for example, any strike or any position?
I feel so empowered because this is like a 2-month journey. Like, I don't want people to think that this is something I've been doing for years. Literally, my first option trade was June 21st, and I was clueless. So
Okay.
I'm sitting here on, August 11th, and I can confidently say on camera, like, this is what you do, and this is why you do that. And so, like, I have no issue or no worry about, will this work, won't this work? I don't feel like I'm gambling anymore. I feel like I am making an investment in my future.
Nice. Well done. All right. So she did the homework, y'all. And you can see that doing the homework pays dividends. All right. So what other questions do you have for us?
Okay. So I am in the process of transferring my money into my traditional,
Okay.
my rollover IRA. So
Okay.
as soon as the money is deposited, I am jumping 2 feet in, buying my 10 contracts. I'm burning my ships. The only way I'm getting back is I got to win the war.
There it is. There it is.
So I came up with 3 ETFs because
Okay.
I wanted to go with ETFs. And
Okay.
I selected SMH, XLY, and XLK. And then I had to pick 2 because, my money ain't that long. Okay, my money is not that long. So I decided to go with SMH and XLY. So I'm going to jump into the pool. So if you guys could talk a little bit about, you always say, before you go in, you want to have an exit strategy. And I feel like that is the piece I'm missing. And I've heard you say before, you talked about a stop loss.
Mm-hmm.
I don't really understand what a stop loss is. And I also noticed that you guys were talking about doing short-term puts against your long-term options. So if you could talk about integrating a stop loss, and then also, I know we're going into put season. So I want to make sure I protect my investment.
Winter is coming.
It is. It's gonna be
Don't
cold.
remember.
All right. So first things first, whenever you're thinking about doing, let's say, any trade, you always want to set goals for yourself. So some folks, they'll say, okay, and this is where it comes down to having a trading plan, and which, there may be an episode coming out, but one of the things in which that we say within setting up a trading plan is setting a goal. And so in order for that goal to be, actually a real significant goal, is we put it by a SMART metric. And so for anybody that needs to know what the SMART metric is, it's got to be specific, it's got to be measurable, it's got to be attainable, it's got to be relevant, and since we're trading options, it's got to be time bound. If the stars don't align for all 5 of those, exit stage right to this position. All right, so when we think about it, a SMART goal would be, say, for example, hey, I'm playing a 2-year long position. I understand how options work in the sense of percentages and how they come. So I would probably set for a 1.5-year position, I would probably set my target between, let's say, 200% to roughly 450%. Now at that percent, when I get to the 200%, I'm watching a little bit more hawkishly than I ever was before. Because typically for it to get there, you're more dovish. So then when you get to 200%, you're more hawkish. You're looking to see, you're being skeptical of your own position. And typically around that time, depending on how much time you have left on the position, you're also playing puts against yourself. So the reason why you do that is because just in case if you're seeing any headwinds up ahead, like an election, if you're seeing any potential headwinds up ahead, or we like to call them potholes ahead, you prepare yourself. If you know that there's a street that there's potholes, are you going to run on regular tires or are you going to run on run flats?
Run flats for sure.
There you go. So the put is literally you switching your tires and saying, hey, I'm going to run on run flats. Because though that you're going to face some pain in your long-term positions, just a small little sting here and there, what you're going to do is you're going to make capital, you're going to make money on the downside. So any potential losses, you're actually lessening your losses by gaining money on the downside and betting against your own positions. And then when those start to run out of gas, you take the cash out, and then you have the option of either putting that into the existing position that took a little bit of a few lumps, so that way you can beef yourself up, or you can actually, say, for example, find another position. We call that now you're in the position of being able to leverage. You've added liquidity and now you've got leverage. So when we talk about you reaching your goal, let's say that you reach the 450%, but let's say that you still have a ton of time still left on the clock. Now at that point, it's time to either one, say, hey, I'm exiting stage right, or two, it's time for me to re-examine what my goals are. So if I'm re-examining what my goals are, again, it has to go by the SMART metric. And if you're using the SMART metric, you're saying, okay, hey, I've had a hell of a run here to 450%. There's an opportunity for me to run to, say, for example, another 200%, right? Some folks say that. But here's where a stop loss comes into play. You put in a stop loss of 20%. So to say, hey, I'm going to give myself the opportunity to still keep running, but I'm still going to put in a stop loss or a stop on quote, depending on where your brokerage is, or a stop limit. You're going to put that in there as your fail safe. So just in case if you are wrong and it drops 20%, it automatically will cash you out. And at the same token, you walk away with, a nice hefty profit. And that's ultimately how the game is won and how the West was won.
The West was won. But let's talk about this weight though, between when you first buy your option and you get to 100%, it is tempting to take it out, especially if you see it going up and down, up and down. And I just want to talk about like the emotional aspect of that does need to be removed, but I mean, we're human, so that does happen. So one thing that Matt Reese,
can I quickly jump in for a hot second? Y'all,
go ahead.
This video is probably about to be legendary. For the first time ever, we may possibly cross 1,000 people watching this show.
Confetti.
Tell a friend to tell a friend, baby.
Yeah, whisper.
Right, y'all share this right now. Stop playing, share it right now. But what Matt Reese always says, and this is a lesson that it was a tough lesson that we learned earlier this year back in March, is stick to the plan.
Yep, stick to the script.
Stick to the plan, okay? Don't play no games, just stick to the plan, right? And, coach knows about sticking to the game plan and knowing when you have to be dynamic to do a different play. But that also comes with knowing what's out there. So it's really important that as you're looking at your position going to on the road to 100,000, because remember, in the world of stock options, 100,000 or 100% is like minimum. All right, it's like if you ain't getting 100%, you need to reevaluate what happened to your stock option. So you get that minimum, and then this is where that self-talk comes in, where you really, I don't know if you got to wake up at 5 a.m. and do affirmations, do something, but stick to the plan. Because if you get out early and you leave money on the table because you didn't stick to your plan, you're gonna have regrets. You're gonna have Mark over here sipping water. You don't want to do that. So I just say that as a warning, that as you start to see the 100% and it starts to go over, and then if it comes back down a little bit and then goes back up, I'm just letting you know ahead of time that it's real. And also there's that potential for it to go even higher. So just keep that in mind.
But, and so here's the thing that what you can do when you make it to that 100% return, because a lot of options, once you make it to your first 100%, it kind of like the novelty factor kind of wears off. It's like you kind of get adjusted to it. And so what you can do though, if you want to still protect, and you can keep adjusting as you go along, you can set, say, for example, a 15% backstop against your 100%. And as your position keeps climbing, you can keep adjusting your backstop where it, say, for example, where it ends. So that way you can still keep that gap close. So that just in case if you don't want to lose money.
Right. But you also got to be careful with that.
Wait, hold on. Go ahead, coach.
Go ahead, coach.
What's a backstop?
Yeah.
So for those who may have basketball courts in their garage or in their driveway, you probably can attest to this. You shoot the basketball, the ball hits the rim, and then heads over towards the neighbor's side and is about to hit their car. Now, a backstop would be having a net, a net that ultimately protects the ball from going all the way over to hit their car. Now, let's bring it over into the investment landscape, shall we? The backstop is you putting in a stop loss or stop on quote. So just in case, if the position starts to take a dive or it goes backwards, then you're protected. Your profits are protected. So you don't even have to think about it. Let's say that you wake up and then all of a sudden the market is significantly down. You're okay because you've already put the stop on quote there.
Yeah, there's been many a times where I woke up and the market just took a dive. Well, in my opinion, it was a dive. It really wasn't that serious, but it took a dive. And I woke up and saw cash on the side. I was like, oh, some things must have sold. And then I had my money ready to go so I can re-enter. So I'm a big fan of the stop loss.
Okay.
And yes, we will do a video where there will be a trailing stop loss for those who are asking about this key. So we'll probably, it may show up as a 60-second come up. You never know.
Saturday's coming.
Saturday is coming. All right, who else do let me check in with these comments right quick. Okay, first of all, y'all are hilarious. Who said y'all were comedians? I did, because you got me over here cracking up. So Brian says, get those practice shots up first. What else we got? Shout out to the community. We're all in here trying to better ourselves. We got some questions or comments rather about puts.
Okay. What would you like to know about puts?
I believe Coach asked something about puts.
Yes. So is there so that was, you actually answered one of my questions. So goals are one of my questions. So when it comes to puts, is there a particular season of the calendar year? Like you talk about potholes with, an election.
What part of the season is it where, say, for example, the market seems a little bit less love towards the positions that you like? Yes, that is very true. So we're actually in one of those seasons. Typically when you look at the market, you typically see the volume start to slow down around August/early September. Now, typically around that time, it's about the same time that everybody's supposed to be on vacation, but thanks to COVID, that's out the door. So everybody's still at home, they still are with their kids and they're still trading. But typically August and September are typically known as garbage months, but at the same token, for me, it's not a garbage month because it's, if you're a trader and if you're thinking on a long-term scale, this could be a great time for you to be picking up long-term positions that will be coming to you at a discount. That's like, for example, would you rather buy, say, for example, some shoes or whatever it is at full price, or would you rather wait for, say, for example, a 40% discount? Product is still the product, but at the same token, the discount is, it makes the product a little bit more enticing. So the cool thing about playing puts is the fact that the other part of, let's just go to charts. Should we just go to charts? I think we should just go to charts.
It is Trade Talk Tuesday.
It is. And in Trade Talk Tuesday fashion, and people, but by all means, if you're part of the Gotham squad, please definitely tell us, hey, we want to see the charts. Just type in charts and we got you.
Before you get into that,
yep.
There are 80 billion comments about the side bay business, and the side bay we haven't identified the side bay yet. So thanks for asking, Ebony. We haven't identified the side bay yet. You will be the first to know when that takes place. Currently reviewing applications.
So we haven't identified.
Nah, bruh.
Okay.
Not yet.
All right. So
that was shady. Anyway.
No judgment. All right. So let's go ahead and pull up this beautiful full screen of someone's bay, SMH. Now notice we're starting to see some heavy duty volume and seller activity here. Now, when it comes to, because I think that we're kind of leading towards that next thing, which is how is it that you find the strike price for your puts? Right?
Mm-hmm.
Yes. No? All right. So when we're looking at it, we saw that we were at the high at, say, for example, the 170 or 173. And we've kind of come down to the 167. Now, of course, we hit a support level, but it could break down to, say, for example, here. Now, if you're like, now when you start noticing, like we've talked about in the beautiful Bollinger Bands, one of the things that we say about being in a Bollinger Band is whenever it comes outside the Bollinger Band, it's going to retreat back inside. Now notice we're starting to see a little bit of a swell of volatility here where it was a little bit less volatile. So that's telling us that it's going in the opposite direction to what everybody expects. So what I would do at this point, and if I'm already in the long-term position, now I have to ask myself, okay, well, here's the first support level here. The next support level probably comes down to this range of about 163, 162. Now, of course, that's pretty much on par because of the fact that our midline here is at the 165. So what I would do is I would say, for example, put out a put from the 165 to all the way to the 163. So I'd probably come in at 164, excuse me. And from the 164, I would play that one till, say, for example, September 18th, or probably a December call or a December put, just in case, also including election, when you see some of the greatest short seller activity take place. Or you also see, it's pretty much hit or miss where you have, say, for example, short sellers, as well as folks in which that are betting, because they're betting on pretty much who's going to be the candidate. And based upon the candidate, they're betting on the fact that the algorithms themselves that institutional investors get to use, that retail investors don't really get to use quite yet, where algorithms pretty much will trade based upon the news. So they'll sell or they'll buy based upon the news.
Well, I have a question for you, Mark.
Hit me.
How is your flexibility?
How is my flexibility?
Yeah.
I mean, in being in this market, you always have to be flexible.
Right. So with that flexibility, let's talk about these splits. Let's just get into it.
Oh, we switching gears now.
Switching gears. We switching gears because that's like the topic of today, you know?
Oh, okay.
Ease you in, you know?
Which one do we want to talk about first?
Well, you know, I mean, let's talk about, well, first of all, let's talk about Tesla. Then also, you know, we still have Apple. There's been some questions about Apple splits and all that. Even though we covered it, we can talk a little bit about that now. And then we could talk about like who might be next, because everyone's out here doing gymnastics, it seems.
I mean, you know, I just want to point out for a second that once upon a time, there was a guy who wore a Patriots hat and then he looked into his crystal ball and said something. I don't know if he said something about, you know, possibly Tesla taking a split before, you know, they go to the S&P 500. So we're sipping now. Okay. All right. So I just wanted to make sure. Okay, so we're sipping. All right. So I think that this is a brilliant move, and Tesla jumping in the fun with Apple. I'll link them two together. I think that it's amazing because of the fact that, one, Tesla realizes that their stock is way too expensive, especially for the average investor. When we look at the volume, when we look at what the volume could be, and Apple did this very brilliantly. Let's travel back in time to, I think it was 2014, 2015, where Apple was getting ready to hit $700 a share. And they were like, maybe this is a little bit too rich for a lot of folks who want to invest in us. So they did what was called a 7-for-1 split. Oh yeah, they've done this before. Oh, we just living out a rerun. So what they did was they did a 7-for-1 split, and then the stock pretty much traded at $100. Now here we are again, and the stock is pretty much knocking on 500's door at a 4-for-1 split. So if we get at 500, I think that puts us at like a 125 per share, and a 4-for-1 split. And that's brilliant. Now, I mean, did Apple really need that? Not really. But at the same token, was it a good move? Yes, especially since we're now in the age of fractional shares, as well as folks buying through ETFs. It makes brilliant sense. Now, the thing about Tesla is it needs to become cheaper, especially since they're going to be making a move onto the S&P 500, especially when you have a lot of folks. And here's the reason why the S&P 500 really matters, especially to a company like Tesla. When you think about the S&P 500, it's considered, say, for example, the exclusive club, the who's who of the market. I mean, though that, some folks can make the argument is the NASDAQ, the new S&P 500, but I ain't the one to gossip, so you ain't heard that from me. Anyways, so when we look at the S&P 500, it's typically known as an exclusive club. So which means that you have to meet certain upper echelon requirements within the market. And Tesla has finally hit those benchmarks. And so the problem is that its stock is just too rich for a lot of people's blood. So given that you give it a 4 or 5 for 1 split, now this becomes a little bit more ingestible for other investors to say, okay, hey, I'll munch on it. I'll take on a few more shares and everything else. And so it also makes it easier for it to enter into other ETFs, because we only know of Tesla to be into, pretty much really one ETF that's really been pulling the entire ETF, which is ARK. So you have ARKK, ARKW, I think it's ARKQ for self-driving.
Mm-hmm.
And so they've been pulling along that ETF, and ultimately that's one of the best performing ETFs on the market. Now, in order for Tesla to expand itself, because once you come onto the S&P 500, now you have the attention of money managers, hedge funds, pension plans, and everything else, in which that they will buy the stock. But they're not going to buy a stock that's too rich. Thus, Tesla doing a 5 for 1 split, which is pretty smart. Now, when we ask the question of who could potentially be joining in on this party, there are some names that come to mind. There are some names that come to mind. Like, for example, there is another company that's based here in the Northwest that has been known to disrupt a lot of stuff and spook a lot of people.
Yes. Mm-hmm. Mm-hmm.
If you need a further hint, they created a building that's made out of glass that is in the form of 2 balls, like 2 globes. So there's your hint.
That's a pretty easy hint. So y'all should know who that is.
Yes.
Question from a super chatter. What is the effect of splits on options, stock prices, and contracts?
So actually it doesn't affect your option at all. So if you have an option contract, let's say, for example, for a Tesla 1600 call for, let's say, January 2022, just hypothetically speaking, purely hypothetical. But if you're in such a trade, then if the stock splits, then ultimately it just adjusts, the option will automatically adjust its value. So that way your strike price will automatically adjust to what the current pricing is. And on top of that, it will also adjust as it pertains to your contracts. Everything adjusts accordingly. Now, does it change the value of the position? No, it does not change the value. The values remain the same, and the stock still has to perform. So the only thing that you get is, but in the options market, though, it's a little bit different from the stock, because when you add more contracts to the party, it's just different.
We got, Matt Reese is excited about these splits. Always got to shout him out.
Oh, well, I mean, who doesn't love a good stock split?
Brandon is coming for you. He said, that's a bad example, Mark.
Explain, why is it a bad example?
I don't know.
Because when we think about it, you look at the stock, it splits. So for example, let's take hypothetically just Apple's at $400 a share. And let's say that you played a $400 strike for, say, for example, Apple for January, and the stock splits. Like I said, the strike price is going to adjust itself based upon what the actual value is. So for example, if you had a $400 strike and it does a 4-4-1 split, the actual strike price becomes $100. It becomes $100. The contracts also take a split because they also have to adjust for their value. So I don't see how it's a bad example. That's just the facts.
All right, you heard it here first, folks. We got some comments about Google possibly splitting. There was one, where did it go?
It's gonna be kind of hard for Google to do a split, though, because of the fact that they have 2 different classes of shares that are on the publicly traded market. A lot of folks don't know this, but there's two tickers that are actually Google. So you have GOOGL, and then you have GOOG.
Someone asked, when does the fundamentals of Tesla matter though? Because technically it should be at $300, right?
No. You have to look at it like this. Are you looking at Tesla as a car company, or are you looking at Tesla as a tech company? Are you looking at Tesla as an energy company? Or are you taking those all into consideration?
Mm.
So people thought the same thing about Amazon and saying that it was overvalued, and look at Amazon now. I mean, to every single one of those. I mean, and I hear it. That's a lot of times you hear that from value investors because they're very sticklers for valuations, aka company value. But at the same token, to say that, Tesla was priced where it was priced. People bought the stock because they believed in what the vision for what the company was. To my knowledge, they've executed on every part of their vision. Of course, nobody's perfect. And at the same token, I mean, they're the leader in the pack as it pertains to self-driving cars. I mean, they're really making some significant moves as it pertains to energy. So yeah, I just don't see Tesla at $300. I don't see it at $300.
Yeah. Okay, so all these comments are about Tesla.
Oh yeah.
Okay, we have another question. Does the split ratio, I don't know if you already answered this because
I just did, yeah.
Okay, cool.
Is there value in taking your profit from your option and buying the actual shares of the stock within your investment portfolio?
It depends. I mean, I'm never going to knock anybody for, say, for example, especially if you're thinking about the long-term play. I mean, it's a good move. I mean, when you think about it, like look at all those long-term investors that, say, for example, invested $1,000 into Netflix, and then 10 years later. So, I mean, every stock is different. So if we had a company that we were talking about specifically, then it changes the game. But I mean, if you're talking about making the move, are we talking about making the move from going from purely just option and buying the contract, buying the actual 100 shares and then sitting on them?
I don't know. I would say initially no.
Because here's how it works. And by the way, I want to put this out there for folks in which that are thinking that you need to wait till the expiration date to sell your option. That is not true. You can sell your option at any time. So you can literally execute and sell it off, but way before the expiration date meets. I was seeing that in the comment section. But the thing is like, here's the conundrum though. If you want to execute that into shares, and here's where my logic comes into play. If you're thinking long-term, then great. But keep in mind, you just had a very awesome run-up in the position, let's say as an option trader, to then turn that into stock, which I understand the long-term fundamentals and everything else, but you have to ask yourself, why were you getting out of the option in the first place? You probably saw some potholes ahead. So you would be buying into the stock for it to potentially fall. Or even let's say you went out on top and said, okay, hey, there's still more room for it to run and turn it into stock. It's a tough one. Yeah. It's very much so a tough one. And for me to sit there and say that there's a specific answer, I mean, I wouldn't be doing any of you any justice, because if you're thinking long-term, it's a good move. But if you're thinking about, say, for example, building up liquidity.
Yeah, I feel like a key part of all this, I mean, when I say this, I mean, the come up is that liquidity factor. Like you got to move and groove and stick and pick, okay, before you can, as you build up your liquidity. I think it makes more sense to start off. I mean, maybe you need two separate accounts, but start off with your options so you can build up your liquidity, because the growth out here is real. This math is different, y'all. It's different. We done showed you the math is different. So build up that liquidity and then start thinking about, I mean, if you want.
Yeah, and keep in mind, it's like options is just one of multiple vehicles.
Mm-hmm.
So if options is not for you, here's the cool thing about what we talk about. The positions in which that we focus out there that are on our hit list, they work either way as an option or also as, say, for example, a long-term investment. So the biggest thing that we look at is we don't really focus a lot on short-term investments. We really don't, because we really focus on building things in which that we believe are something that are structural and something that are, when we say time bound, we're talking about more so in the sense of you allowing yourself to buy yourself time. You're buying time. And when you play short, you don't really give yourself very much time, and a lot can happen. So yeah, I mean yeah, I would say if you want to play stock, like in the sense of investing in stock for the long term, good for you. Go for it. Like I said, just do your same due diligence and looking at the fundamentals. When you look at playing an option position, the only thing that you got to do is you got to do a little bit extra homework, because not only do you have to look at the fundamentals of the company, but you also have to look at, say, for example, hey, is this the right time to get in? Also, how much time am I actually affording myself for this position to mature? That's another part of the homework that comes into play when you're playing in the options game, or quote unquote derivatives. So, and one carries more risk than the other.
Yeah.
As a beginner, so initially I thought I had to have like this full menu of different ETFs and stocks that I did options with. And just from continuing to watch you guys, I understood that less is more, especially as a beginner. So that's how I got to my two. Like, I understand the value in, don't have the whole car parking lot, just get in your driveway.
There you
with
go.
your car. I've heard you guys mention about shaving off.
Yes.
What exactly does that mean? Is there a percentage that you shave off as you progress your
Jolene,
contract?
would you like to talk about shaving off?
Yeah, one of my favorite things to do.
No, seriously, it is. Like, she's got it down to a science.
So for me, like the way I look at it, first when I buy my contracts, I'll be trying to be in that 3-figure club for the contracts. And I already told you guys last time how long that took. But so if I buy 100, let's say I buy 140 contracts of whatever, and it's running high. I know it's going to come back down. I mean, you can look at the Bollinger Band and you can see it's going to come back down and touch that midline. And for me, I'm not trying to leave no dollars behind. Okay. Like, every dollar is precious to me. So I would potentially shave off like the 40. And I would do that once it hit, I would look at it at, there's a couple of things I look at. One, I look at, okay, am I over 100%? Like, for example, right now in XLY, I'm over, what am I at? Like, I'm over 800% right now. But I'm not touching it because it doesn't expire until January, number one, January 2022. Second of all, we haven't even got through December yet. Third of all, I mean, how many 52-week highs have we had yet? So I'm rocking with it, like, I anticipate it going much higher than what it is right now. It touched like over 900% today. So, and then it came back down a little bit. So for me, I would look at where I'm at percentage wise, how much time I have left. And then I don't really like to have odd numbers. So I would just shave off the odd number amount so that I have an even number left. And then, but I don't shave unless I have some idea about where that money's going to, because I don't want it to just sit there on the side. I take that money out and I already have a plan for it. If I don't have a plan, I will have a plan tomorrow, So that's kind of a little bit about how I look at shaving, but it's like one of my favorite things to do because I like to see that cash and I like to move it and put it into another position that's going to take off as well. And so just imagine having your solids. Like, for me, my hitters, XLK is a hitter for me. I was able to shave some off. I think I must have had, I don't know how many contracts I had, Mark. I had a lot, and I shaved some off. I bought Apple. I sold Apple before it had got over $300. And I think I had it was 320 was the strike. And it got to over $400. I sold that. I didn't wait for nobody's split because I needed that money to stick it into ARK. I knew I was going after ARK. Now ARK is in my portfolio, clowning, okay, living life. It looks so precious. It's so cute. Like, I'm just like, yes, ARK, get it. So what I do is shave some off and apply it to the next thing. I do not leave it on the side. And I really look at it when it hits about 100%. When it's starting to run high, like if those 52-week highs are already coming, I know it's going to come down. It's inevitable. It's going to come down even a little bit. I don't want to leave any dollars behind. And I still maintain a sizable amount because I know that by the time it hits to, like through the different seasons. So for example, for XLY, I'm waiting for retail. I'm waiting for this holiday season. I anticipate that a lot of sales will be made because people are bored. People are sending gifts to each other because there ain't nothing else to do but shop. All right. So that's,
And that's pretty dope what you mentioned, like, because a lot of trades are quite seasonal. So for example, you have to ask yourself, when would consumer discretionary have its biggest moment of the year? There's 4 seasons in every year. I mean, just like there's 4 quarters in every year that a company reports. So at what quarter is a game time for consumer discretionary? The 4th quarter. When we look at, say, for example, other areas, you have to look at it by a seasonality factor. And that's why you probably hear the word cyclical.
Okay.
Just
and is it wise to stay early on to stay with, what I start with? Or like, when do I understand and to expand beyond, all right, this is what I'm familiar with. I understand how this ETF works. I understand the seasons of this ETF because I sometimes I get a sense of overwhelm. Like, I see so many different, options, not like choices, and I want them all.
I think the biggest thing is like, and that's where we say it's like, start with your starting 5.
Yeah.
When you look at, say, for example, the Showtime Lakers, you knew who that starting 5 was. When you look at those 90s Bulls, you knew who their starting 5 was. Every now and then they may have had a sub player because somebody got injured, but deep down, we knew out of the 82 game season, 8 through 90% of those games, we knew who the starting lineup was.
Okay.
And so when you look at it in the same manner of companies, or let's say your ETFs, many times you're looking at who the top 5 are or who the top 10 are. And in some case, if you're lucky enough, you know who the top 15 are. So pretty much who the whole bench is, so like who the team is. And so at that point, what can make you very overwhelmed when you're looking at ETFs and everything else, I would say narrow it down to the companies in which that you really, really like, that that are winners. Like, I consistently say this, pick winning companies. And then when you pick winning companies, you can literally find where those winning companies also sit in, where, say, for example, you can look at and say, what's in this stuff? It makes it so much easier. And then, like, for example, like Jolene likes to say that, her and her relationship was rocky with SMH. But here's the funny thing. They may hit a rocky road, but then at the same token, I guarantee you that her and SMH will find each other somewhere down the road again. Like, for example, she likes the ETF XLK, or she likes Apple. I guarantee you, if you ask Jolene what her top 5 companies are, you see it play out pretty much within her portfolio. You invest with where you like, you invest with where you're comfortable. And what I mean by comfortable, and I don't want people to say, okay, hey, I invest in Starbucks because there's a Starbucks in every corner. That's no. You invest based upon, you find the companies that you like that are based upon the data in which that was validated first. And then once you have that data that was validated first, like, for example, a lot of you want to know, like, why is it that a lot of folks like Apple? Here's a simple key. There are 2 main cell phone manufacturers in this world that are at the top of this mountain. There's Apple and then there's Samsung. And so let's just say that Samsung and Apple both sell a phone that costs the same, right? $1,000 for each phone. Now ask yourself this, which phone is more profitable? For example, Samsung, do they make Android? Do they make all the chips that are, say, for example, going into, let's say, do they make the chip that goes inside the Samsung device, especially the one that's sold in the United States? No, that's Qualcomm. Do they, say, for example, own all the patents to, say, for example, gestures that go with Android? No, they don't. A lot of folks don't know that Microsoft also collects 15 bucks off of every single phone sold. When you look at now Apple, when you look, and what we're calling that is, we're talking about profit margins. We're talking about profit margins in the sense of, okay, it cost us, the phone cost this, but how much did the phone actually cost to make? And when you compare the two, like, for example, Samsung may sell more phones, but Apple is more profitable in the phones in which that they sell, which means that they're making more money than Samsung is. That's just a small little tidbit when we talk about, like, for example, the game and the knowledge about comparing companies and who does what better.
So Mark,
that's a fundamental, by the way.
The time is 6:08.
Oh no.
It is. It is. And we do have some announcements.
Oh yeah.
And some changes.
Yes. So, for example, can we talk about the burner?
Yes. Shout out to Matt Burner.
Burner. All right. So for those of you guys that don't know who I am, I definitely like to play burner accounts. Like I, play it a lot. But this one is going to be a little bit more special. The Come Up is actually going to develop a burner account under a brokerage. Now, this is where it's like a lot of you guys are like, well, why should we care? Here's the reason why you should care. Because if you can beat the Come Up, you don't know who you're investing against, but if you can beat the Come Up as it pertains to profits for, say, for example, 6 months, then maybe perhaps the Come Up will have to give you its profits. Just saying, for those in whom have paid attention. Now, again, you never know who you're investing against. I mean, it could be Mark, it could be Jolene, it could be, say, for example, maybe even head coach. But what we're saying is the goal is that if you can beat the burner account, and once we get it set up, we'll let you know. We'll also be transparent on every single trade that we make under this burner account. And the other thing that we'll do is we'll also show you where the position is. Now, what we'll be asking for you to do, and in order to keep in the interest of fairness, is that you will have to keep track of what your profits are and in what positions that you're playing. And you'll have, when it comes time, you're going to have to show the receipts for those positions. But if you can beat the burner, and we haven't come up with a dollar amount yet, we'll probably we'll figure something out. So that way we'll try to make sure that as many people can get in. Who knows? We may even set up multiple burners. Who knows? But the goal is that, we want to reward you for, say, for example, not only taking the time to learn, but also being a part of this awesome community and movement in which that we're doing here. I mean, again, our focus is to pour as much knowledge as we can into each and every single one of you. So that way you guys can ultimately build wealth. And on top of that, share this knowledge with everybody else. And this is just a small incentive. So there that is.
And we have another announcement for Tuesday, y'all. Okay, so we realized the ecosystem, and this movement and all of the players involved that look like us, that are talking about investing and building wealth and doing it for the culture. And so with that, so that we can go on a Tuesday run up, is what I'm gonna call it, for the Come Up, we actually are gonna move times to 6 o'clock. Pacific Standard Time. So that is 9 p.m. East Coast time, y'all. And we're doing that to allow for the maximum amount of exposure to several different entities, from EYL to Wall Street Trapper.
Which
Who
he's
else is
doing his live right now. So
So you know what I'm saying? Like, y'all, we are all in this together. Like, I like to tell people that I didn't grow up in a wealthy family, right? But this is like growing up in a wealthy family where we all come up together, okay? We celebrate each other's wins. We also learn from each other's lessons. So, you know, we got our cousins over at EYL and Wall Street Trapper, and we all are family, so we all got to get this money together. Remember, no dollars left behind. We ain't playing that type of game right here. So 6 o'clock, y'all. Don't worry, we will announce it. On Thursdays, we're sticking to 5 o'clock though, so just pay attention to that time. But yeah, that starts. Are we starting that next week, Mark?
we start next week.
Okay, so next week. Just want to give you guys that heads up. Any final thoughts? Well, first of all, y'all, let's shout it out for the coach, okay? Yes, out here.
Yeah. Yo, man, she was out here balling out of control.
Okay? I was like, look at that, Jay.
I now know that just in case if I ever need to go on sabbatical, I know that the seat can definitely be handled. So well done. Well done.
Well done. And where can we find you at? Where can we find you?
On Instagram and Twitter, at Head Coach Head, and there is one H between the coach and the last head. I live there, so Head Coach Head. I have a website, headcoachhead.com. I try to be rather poetic. Post a blog post every Tuesday, a little motivation, a little leadership. You know, I just try to sprinkle everybody with a little love every now and then.
I love it.
And if you're ever in Kennesaw, Georgia, in basketball season, I got you on the tickets, baby. Anybody, just come on. We need some people in the stands.
Don't play. I'll come through. Okay.
That's what's up. I mean, you know, it's nothing but a hop, skip, and a jump. So I mean, we can definitely make our way there and show some love. Yeah. All right, y'all. So we definitely thank you guys for paying attention and, you know, doing your homework. You know, please continue to send us your homework. All right, so shorts. Let's talk about those really quick.
Yes, really quick.
I'll just say this. Here's a hint. This is your homework. Here's a hint. Anything that, say, for example, took part in rotation today, you may want to give them a second look. Just want to say that there.
All right. Oh, and y'all hit up Coach Head for the Google link. You're gonna get started.
Oh, we're gonna post it on this video for the replay. Cool. So yeah. You'll be forever enshrined on the come up page as long as your Google link stays live. But I mean, you know.
I want to help. Oh, last but not least, my family has a plumbing company in Atlanta, Georgia. So if you got a runny toilet, if you got a leaky sink, you need a new water heater, headsplumbing.com, Black owned small business. My brother runs it. My mother and father started in 1981. So, you know, wow. I got nieces, I got nephews, you know, legacy, baby.
There you have it. All right, y'all. So it's been real. You guys may find me on, say, for example, after the come up on IG later on this evening, or possibly who knows when it will start. But until then, this has been awesome. Like I said, if you liked what you saw, go ahead and hit that like button. Or if you didn't like it, go ahead and hit the dislike. We see that there's 4 dislikes now, but that's okay. Please tell us what we could have done better. And then on top of that, if you want to watch more content, go ahead and subscribe and hit the notification bell to be a part of the squad. All right. So until next time, I'm Mark Monroe.
I'm Jolene GC.
And this was your Come Up Trade Talk Tuesday. Peace, y'all.